And there we have it. Hi, folks. I'm Dan Passarelli. Welcome. And we're going to talk about something really important today, the stock repair strategy. Get your money back on stocks you lost on. Before we even go any further, we have videos on YouTube. You can go to youtube.com/markets taker mentoring, 2 T's in a row, market as in stock market, taker as in take what is rightfully yours, mentoring, because that's what we do here at Market Taker, mentoring. And we've got lots and lots of educational and topical, helpful little short trainings, videos. Please, when you go there, subscribe. That makes sure that you don't miss a single one. Before I get started, I need to point out options are not for everyone. Read characteristics and risks of standardized options before trading. Get a copy of that by emailing investorservices@theocc.com. All right, so once again, my name is Dan Passarelli. I am an author of 2 popular trading books on option trading. I've been part of a couple others, write a lot of articles, do some television, and I'm a trader. I was a professional trader on the CBOE trading floor, Chicago Board of Trade trading floor, still trade to this day. And I'm the president, CEO, and founder of Market Taker Mentoring, which is the world's leader in option trader education. And I'm a trading industry collaborator. I work with lots of brokerage firms, exchanges, players in the industry, software creators, other education companies, trader clubs. And also, I'm a family man. Married to my wife, Kathleen, 2 kids, Sam and Isabel. They're grown. 2 cute little dogs, a Yorkie and a Morkie. And those are the things that I care the most about. And trading helps me to do some of the things with them that I like to do. Some other things that I like to do, some with them, some just on my own, like running. But I'm a runner, foodie, love to cook, love to eat, traveler, and a musician. Now, this right here, I'm going to invite you to join our community for free. Get some free classes. You can join our MTM community chat room, which is a really great resource to connect with other traders. All you have to do is go up to join free and you're in. All right, let's get into the material here. Question for you. Have you ever had a losing trade? Ever once? Have you ever had a losing trade? Give me a yes or a no in the questions box if you have ever lost money on a stock. Give me a yes or a no if you've ever lost money on a stock. This is where I get to see who the liars are and who is really here to get down to brass tacks and learn some stuff. Anonymous says yes. Chris says yes. Oops. Adolfo says, of course, because right. That is not just a trick question. It's not even a trick question. I already know the answer. I just look for people who say no and basically tell them to leave because they're lying to me. They're lying to themselves. Troy says yes. Manish says yes. Okay, good. Well, here's my other question to you. You want to get your money back? Well, I don't think I need the answer to that one here either. But before I talk about how to get your money back, I first want to talk about how not to get your money back. It is typical for novice options investors to use options to try and get their money back. Here's some bad ways to try that deserve discussing. Some people will own a stock. And by the way, let me back up just for 1 second here. When I say ever lost money on a stock, I mean as a long-term investment holding. All right. which makes the answer even more yes, I guess, right? But what sometimes people will do is they will attempt to use options to fix that. And I'm going to present to you a way to do that. But sometimes they just come up with some crazy darn ways that don't make any sense. Like they'll just buy a bunch of calls and hope the stock goes up and lose money on theta with those calls. Or they'll double up. They'll just sell a bunch of puts to get more premium. And then if it goes down farther, they magnified their risk multiple times over. As far as with options go, we don't like to average price with options. We do sometimes with stocks, but that adds to our risk when we average price with stocks. Average price is like if I buy a stock at 100 and it goes down to 80, well, I'll just buy more at 80, which in the long run might make sense if you did your research on fundamentals of that stock. But a lot of investors and traders aren't experts on reading fundamentals. And, with option trading, you don't have to be. So there's got to be a better way. And there are a couple of better ways. I'm going to give you two different repair strategies. So the first one is for small moves. Now, if you're a long-term investor and you buy a stock at 100 and it goes down to 97, you probably usually just want to wait it out. But if it was more like a trade than an investment and you were looking to capture a small move on there over a short period of time, well, then maybe trying to repair those small declines in a stock price might be worth it, might be key. So for small declines in a stock price, an in-the-money covered call might be a solution. Now's a good time to begin the note-taking part of what you're doing here today. Here's the premise. I bought a stock on a short-term trade, not really investment in this case, and I just want my money back. I don't feel I need to make money on this stock trade, but if I can just get my money back, I'd be really, really happy. And if the stock falls, I'd be willing to hold it because I think that I have reason to believe that the stock won't go down a lot more. Like maybe there's support underneath the market. So that is the premise. Both of these strategies, I mean, look, with any option strategy, there is a set of circumstances to use it and a set of circumstances not to use it. These two circumstances from the premise of when I would use the in-the-money covered call. So let's look at an example. And if covered calls are something that is new to you, we did a class here with Firstrade. We did a workshop on, wait, did we do a workshop on covered calls? No, I think we have one coming up. So make sure to mark your calendar as a recurring event every Tuesday at noon Eastern time, which is 11 Central, which is 9 Pacific time. And make sure you watch the one on covered calls that's coming up. And next week, I've got one on the Fed. That's going to be great. So I'm not going to go heavily into what a covered call is now, make an assumption that many of you know what it is. Let's say I bought a stock at 75 and the stock fell to $73 a share. So it's down a couple bucks. If this were a long-term investment, I wouldn't think twice about it. If it's a shorter term trade, then sure, I want to try and fix this. Well, here's what I could do. Let's say the 70 calls are trading for $5. Now, those of you who use options regularly, you might, there's a glaring question here, like, Dan, which 70 calls? The 70 calls that expire tomorrow or a year from now, which 70 calls? We want to keep this as short term as possible. And we want to keep this, we want to keep, and by the way, the questions, Relino and Anonymous, I'm going to answer those at the end of the presentation, okay? So sit tight, and I'm going to address all the questions at the end. So you want to keep the time horizon as short as possible, but what's operative here is we want to sell a call that's frankly as in the money as possible, that if assigned, it's around the price that we bought the stock. So we need to think in terms of intrinsic value and time value. So the 70 strike calls here in this example, with the stock at 73, how much intrinsic value does the stock have, or does the call have? If it's a 70 strike call and the stock is at 73, who can tell me, who can be the first to jump in the questions box and tell me how much intrinsic value that 70 strike call would have with the stock at 73? And this is not that tricky of a question because it's literally on the screen. Yes, thank you, Chris. It is $3, right? Because if I bought that call and I exercised my right to buy the stock at 70, I could turn around in the market and sell it at 73, locking in $3. It's in the money by $3. But if it's trading at 5, that remainder premium is called the time value, which in this case is $2, right? The time value is just the option premium minus its intrinsic value. So that's really the key to this. Now, if you look at any option chain, the further in the money you go, the less time value it has. It becomes closer to all intrinsic value. So we're not going to go really deep in the money. We're going to go a little bit in the money. Oops. The whole idea here is if we get assigned, and let's talk about that for a minute. I know I said I wasn't going to go deep into what covered calls are, but I want to make sure everybody has at least a basic understanding here. If I sell the 70 strike call at $5, what am I doing? I'm giving someone the right to buy that stock from me at $70 a share. And they can exercise that right anytime between now and the expiration of that call. Okay, well, that's fine. Why would I give someone the right to buy a stock from me at 70 if it's selling at 73? Can't I just sell it at 73? And the answer is yes, I can. But the whole rationale of this trade is this $2 time value. I'm basically finding a way to potentially sell it at 75 when it's selling at 73, when the stock is selling at 73. The time value is the key to this whole thing. And that's a way that sometimes people make mistakes on this trade. So if you're taking notes, make sure you write that down. So if assigned, which means the person that I sold the 70 call to, because remember, these are options. There's always two parties to every contract, the seller, which in this case is us, and the buyer. If the person that I sold this call to, who bought it from me, exercises his or her right to buy the stock from me at 70, I get assigned. I would literally sell the stock at 70, but I get to keep that $5. Now, they would only exercise the right if the stock stays above 70. So we are taking on some extra risk here. A couple potential issues. If the stock goes down, or let me back up. If the stock goes down below 70, then I'm going to lose more. I could potentially lose more on this trade, but how much more? Well, either way, I collected $5, right? So if the stock just goes down to like $69 a share, then I would have lost another $4 on the stock, right? We originally bought it at 75. Now it's at 73, and we decide to sell this call at 5. If the stock goes down to like 69, from 73 to 69, down $4, we're actually still okay. We're actually still doing a little better because we would get to keep this $5 at expiration. The calls would expire. We're fine. If it goes down to 68, we're still fine. It's just if it goes down below 67, we run into more trouble. So we actually get this $5 cushion regardless. But as long as the stock is above 70, we're in good shape and we will get our money back. Now, another problem is that what if the stock goes up to 80? Because remember, when we originally bought this, we're wanting to sell the stock higher. We thought we had reason to believe that there would be some upside momentum. If the stock goes up to 80, we're still only getting our money back. We're still, we bought it at 75, we get assigned at 70, we collect the extra premium of $5, we're getting out at 75. So we're giving up our opportunity to make money on this trade, but we're making it more likely that we don't lose money on this trade. Again, this is a very specific situation. You're not going to want to do this all the time. If you're doing this all the time, that means all your stocks are going down and you're doing nothing but accepting downside risk and giving up upside risk. This is a limited, there's a few situations when we would do this, but not all situations. Now, there's some situations where, maybe the stock went down because some news came out and we might not want to hold the stock if it's down. Right? So, and, we don't want to sell like a 1 month call because then we have to hold onto the call for a month and hold on to the stock therefore for a month. Like we want to keep this very short term. We want to keep our period of risk short. And we may not be able to get enough premium to make up for the loss, especially if we keep it short term. If we sell like a 1-day call that's in the money, there might be almost no time premium left. If we sell a month call, there's going to be a lot of time premium, but that's too much time to hold on to that stock. So we're really looking for a sweet spot here. And because of that, we might not be able to execute this even on times that, make sense on paper, times where we would want to do this. We might have to go out too far in time where the hold period is not worth the premium we get. And for the hold period that is acceptable to us, we might not get enough premium. So this is another arrow in your quiver that you'll be able to use sometimes, but not always. Okay, so is there another strategy to repair stock? Yes, and this one is just called colloquially the stock repair strategy. And this is for a different set of circumstances. Whereas the first one was for a small loss on more of a trade, this is for only a big loss on a longer term investment. So I'm giving you two completely different strategies. So let's say we bought some stock, maybe in our IRA or some sort of long-term holding account. It is an investment trade that we probably plan on holding for the foreseeable future, 3 months to 30 years. And it turns out that the shares have lost value. Okay, so this strategy, the stock repair strategy, can be used under certain circumstances where we can make back the entire loss if the stock retraces just part or half of the way. So here's how this works. There's 3 components to this. You can say 2 components, a stock component and an option component, but the option component consists of 2 legs. So we own the initial shares. We bought them, could have been yesterday, could have been a year ago, and they lost value. And they have to have lost a significant amount of value, somewhere between 20 and 35%. If the stock lost like 3%, we're not doing this. This does not make sense. Maybe the other one that we talked about makes sense, but not this one. This is for if it loses 20 to 35%. And we expect it to retrace halfway. Like maybe we bought the stock at 30, it went down to 25, and we don't necessarily think it's going to get back to 30 all that quick, but we think it can get back to like 27 and a half, within a shorter period of time. That's what this is for. So what we do is we buy a 1/2 call spread, which is also called a ratio vertical spread, that has 2 to 6 months until expiration. Now, we kind of want to time this well, but it's kind of tricky to time it well, actually, because if we trade a 6-month 1/2 call spread, we really kind of have to hold it for a long period of time. We don't necessarily have to hold it for 6 months, but we close to 6 months, maybe. If we do a 2-month one, that might not be enough time for it to retrace halfway. Because remember, halfway is we're only looking at stocks that lost 20 to 35% of their value. Halfway is anywhere between 10% and 17.5%. So, 17.5%, that might be a long time, or that might be a pretty aggressive thing to want to recover in just 2 months. Now, it depends on the stock. A stock like NVIDIA, if you're watching this live in the second half of 2024, that stock has had a great deal of volatility. That one, it can make or lose 10% in a couple of days. But that's not a typical stock. A typical stock, to make back 10 or 15 or 17%, typically takes some time. So we kind of have to time the expiration date of these options with our time horizon that we think it's reasonable for it to retrace halfway from where it is now to where we bought it. So the 1/2 is just buying an at-the-money call, and in the same expiration, selling 2 out-of-the-money calls at a strike price coinciding with the price I think the stock can get to. Again, if we're doing this, that's usually about halfway between where we bought it and where it is now. So here's an example. We bought stock at 80 bucks a share. Could have been yesterday, could have been a year ago, doesn't matter. Now it's at $60 a share. So this is a 25% decline, right? We think that by December, which again would be 2 to 6 months in this hypothetical example, by December, it can get back to about 70. Maybe not retrace all the way to 80, but we think there's a pretty good chance that it can get back to 70. Now, the whole objective here is that we bought it at 80, now it's at 60. Usually to get our money back, it has to go up to where? Well, to 80. But here, we're being smart, and we're doing this 1/2, and if it gets up to 70, halfway, we actually get all of our money back. We call that doubling up to catch up. Not ketchup like you put on your hamburger. That was a strategic example. Being from Chicago, we know we never put ketchup on hot dogs, right? All right, so double up to catch up. So what we're doing here is, in this example, because we're buying an at-the-money call, right? Stocks at 60, buying the 60 strike calls, buying one of them for my 100 shares. We buy that at 4, and we sell short 2 of the December 70 calls at $2. So there's kind of a lot of really important things going on in this hypothetical example setup here. First, I want to call your attention to bought the stock at 80. Now it's at 60. I'm buying the 60 strike call and selling the 70 strike call, not the 80 strike call, the 70 strike call. Halfway. The other thing I want to call to your attention is I'm buying one call at 4 and selling 2 calls at 2. 2 times 2 doubled, because there's 2 calls at $2, means I collect $4 on the December 70 call, two lot call. So I paid 4 and I collect a total of 4, which means I'm paying 0 for that spread, which means I'm not adding any additional risk. Because if the stock is down, if these options are both out of the money at expiration, the stock is at or below 60, both of those calls expire, and the 0 I paid, it's done. I paid 0. I didn't lose anything on them. Didn't make anything on them, but I didn't lose anything on them. So I'm taking on no additional risk, but the word additional is very important too, because I would still have the long calls or the long stock. If the stock goes down from 60, I can lose more on the stock. So I would only do this under a couple sets of circumstances. Circumstance number 1, and this is the most important one, is that I am willing to hold the stock because I think we've probably bottomed out. It's lost 25%. Now, sometimes companies lose 100%, Enron, like they just go to 0, but that almost never happens. If you think this is one of those cases where that could happen, because it does happen sometimes, then we would never want to do this strategy. This is a terrible strategy if we think the stock is going to go down more. And look, we can't read the future. We can't see the future. So we don't know the answer, but if we emotionally detach ourselves from the fact that we lost $20 a share here, $2,000 on a 100 lot, if we emotionally detach ourselves from the loss and reanalyze the stock and say, oh, well, look, here's a whole bunch of support here at 60. They just had bad earnings, and they said that next quarter they have some challenges, but it's not going to be terrible, and that they see a brighter future. Hey, I still want to keep this as a long, I still believe in them. I don't think it can go down anymore, but I don't think it's going back to 80. I think it's going to grind a little higher over the next 2 to 6 months. That is the circumstance that we would use this. So we will be accepting the fact that if it goes down more, we lose. We don't have to accept that fact. If we're afraid of that, we don't do this. We just sell the stock and take our loss. So the idea here, though, is we're not taking additional risk, but we can profit on both the stock and the options position if the stock rises. So it's almost like freaking magic, right? Because we're not taking on more risk. So the option position itself can't hurt us. It can only help us, which sounds like a pretty crazy thing to say, because I'm the first person to tell you, like, there's no free lunch when it comes to trading or investing. You can't have a situation where you can only win. But this one you kind of can if you accept the fact that you're willing to accept more downside risk in the stock. It's kind of like this is a really special strategy under the right circumstances. Under the right circumstances, it's just an amazing strategy. So with the stock down $20, we can make all our money back if the stock rises just $10. Okay, let's get under the hood a little bit here and see how this really works in real life. So This is the stock, 100 shares, with the long 60 strike call, with the two short 70 strike calls. Though we paid 0 for the 1x2. So 60 strike call, 70 strike call, where we bought the stock. If the stock is under 60 at December expiration, what happens to the stock? Well, nothing happens to the stock. We still own it. So we still have that risk of 100 shares here. But what happens to the 60 and 70 calls? Well, they're both out of the money if the stock is below 60 at December expiration, which means they expire and they go away. Poof. So it's just we're long 100 shares. That's it. But now, if the stock is above 60 at expiration, here's where this gets interesting. This middle area is what I'll call the sweet spot. If it's above 60, but below 70 at December expiration, what happens to the stock? Well, we still have the stock. What happens to the 60 calls? Well, we would exercise them and buy the stock at 60. So if the stock is trading at 65, we're buying it at 60. So we're getting an extra $5. So that means we'd have made $5 on the stock, and we've made $5 on the extra stock that we got by exercising the calls at 60. How much did it cost us for this? It just cost us 60 bucks. It didn't cost us any extra option premium like you would factor into this with other option trading strategies. So that's great. Between 60 and 70, we're doubling up the number of shares. What's the trade-off? Where's the catch? Well, we can call it a catch, but it's actually just part of the deal that we're making when we put this trade on. If the stock is above 70 at expiration, then we're short 2 of the December 70 calls. So the 200 shares of stock, right? Because we owned 100 shares of stock. And if the stock's above 60, we own another 100 shares of stock when we exercise it. Those 200 shares of stock, we can think of the 270 calls as like 2 covered calls. We get assigned at 70 and we sell the stock at 70. So how much would we have made? Well, the stock itself, top line here, we'd have made from 60 to 70, we'd have made 10 bucks. The 60 strike call that we exercised and bought more stock at 60, if the stock's at 70, we'd have made another 10 bucks, total of 20 bucks. And then if the stock's at or above 70, we get assigned, sell it at 70. So we got our 20 bucks and we're out of all the stock. Thank you very much. We got 20 bucks back. We were only down 20 bucks, got all our money back and accomplished our goal. It's crazy. What's the downside to this? Well, I told you one of the downsides, right? If the stock is below 60, we still have the risk of owning the stock. So we'd only do this if we're willing to accept that. But, like another thing to think about is what if the stock does get back up to 80? If this is like a 4-month trade, stock gets back up to 80. It's not crazy to think it can go up. Well, if it falls 25%, it has to rise 33% to get back to even. So there's that. And stocks do trade in percentages. But if it gets back up to 80, then we're still only getting our 20 bucks. Now, if we didn't do this trade and it got back up to 80, then okay, then we still get our 20 bucks, but it had to go so much further and we basically accepted more risk. This is actually a risk limiting strategy, but it's a profit capping strategy. If the stock's at 90 or 100 or 110, we're not participating in that profit from the stock. We're selling the stock at 70 no matter what. So this is a situation where you don't think it's getting above 80. You kind of don't care if it gets to like 71, 72, 75, 79. You actually still do better if it gets to 79 by December expiration, because you're getting your whole $20 back. Whereas if it got to 79, you didn't do this, you'd only get $19 back, right? 79 minus 60 is 19. So like, it benefits us anywhere between where the stock is now and where the stock was when we bought it. That's pretty darn amazing, isn't it? So even if this doesn't work out perfectly and the stock gets to 70, even if it gets to 62, we've done better. And we can, we could let it expire and just take a partial recuperation of funds. Or, we could close it. We could sell the one back, because if the stock is at, say, 62 at expiration, well, the 70 calls are going to expire. The 60 calls will be worth 2, or will be worth 2. So what we bought at 0, we could sell at 2, and then we could roll out and do the March 1x2. In that case, we'd buy, like, if there's 62 strike calls available, we'd buy the 62 strike calls and maybe still sell the 70 calls. Or maybe 72 calls, try and do a little bit better. So we're giving up upside, and it's very important to understand that. Like, you don't want to be that guy who, like, says, oh yeah, I'm happy just to make my money back. And then the stock's at 90 and you say, oh, stupid, why did I do that? I could have made more. Well, you know what? You can't see the future. You made a really good trade, a really good deal with your brain, and it worked. So, you have to be happy with the fact that I didn't make extra profit. This worked out as planned. Yes, I left money on the table, but I did something smart. Now, you can think of this two ways. You can think of this as a covered call, long stock and short a call, right? Like, I own this stock, and one of the December calls would go against that stock to form a covered call and a debit spread, right? Because then I'm long 160 call and I'm short the other 70 call against that. So it's basically like a covered call and a debit spread. That's the best way to think about it. Or you can think about it as, hey, this is 2 covered calls if the stock's above the long strike at expiration. So a couple of parameters that are important to think about. I'm going to reiterate these. If you're taking notes, take these notes. Take a screenshot. Do whatever it is you have to do to remember this. So the time horizon for the 1x2 prices to actually work need to be between 2 to 6 months. It works best if the stock is lost between 20 and 35%. Again, if the stock fell 2 or 3 or 5%, you don't do this. Maybe you do the other one we talked about, because it doesn't matter. This is a long-term holding. Like, you're going to be down 2 or 5% on long-term holdings time to time. 10 years from now, it's just water under the bridge. The stock is, if it was the quality company you thought it was, the stock's higher and you're fine. If the stock's down like 90%, well, then you probably should have taken action a lot sooner, and this is not going to help you. And when I say it works best, if the stock is down like 10%, you're never going to find 1x2 prices where you buy the at the money and you sell halfway between where the stock was when you bought it and where it is now. You're never going to find a 1x2 that makes sense if it's only down 5 or 10%. And if it's down 90%, you're never going to find a 1x2 that you can do for close to 0. And that's the whole point of this. You need to do that 1x2 for close to 0. The long strike is always as close to the money as possible. The short strike is halfway to reversing the loss. Between 60 and 80 is 70. We're only going to trade this if we're expecting that halfway retracement. We think that's likely. So let's look at a realistic example. This is a stock that I own. Prices are not current, but if you're watching this live, these are the prices a couple hours ago. If you're watching this on a recording, then, they're not current, but I want you to be able to spot these and recognize these examples so that when the time comes that you need these, you can do it. So let's say an investor bought this stock when it was up at 100. He had a pretty darn bad time. Okay, bought the stock when it's at 100, and earnings comes out and whack. Now it's down at about 80. Now, interestingly, and I'm choosing this example and I'm doing it this way for a reason. When I took the screenshot, this stock was actually at 79.41. But I'm going to call it 80 because 69 cents, who cares? That's a very small part of this whole trade. So I'm rounding here, but I'm pointing that out because, well, you're going to see why I'm pointing that out, that 69 cents is a small part of this trade. So, okay. OKTA is down 20 bucks, went from 100 to 80, which is 20% from the purchase price in this example. It kind of bounced off the lows, showing signs of establishing support and maybe making a comeback. In fact, like we literally kind of have support there, right? Because about a month ago, it bounced off that area. So we kind of have support. So we think it won't go lower and permeate support. We're looking for a partial retracement. Now, to be fair, the stock's a little bit volatile and this was sort of in sympathy with the market. It was this down move and this very, very, shooting for the stars, big up move here. You don't really see that often. I wouldn't expect to see another big shooting up move. I think that for it to get back up to 100 is, at this point, it's probably going to take a while. But, to get up to 90, that's probably not going to be next week or the week after, but 2-3 months, yeah, maybe. OKTA has mild resistance at 88 and strong resistance at 92, right? 88, yeah, we've got some mild resistance there. 92, yeah, we've got some strong resistance there. So I think, it's pretty reasonable that this stock can get up to 90 bucks over the next few months. So here's my plan. I'm not going to sell the shares because I think that support will hold. I'm happy to just get out of this thing with a full refund if the stock rallies halfway back to my original buy price. There's just too much volatility. I want out in this example. So we go into our Firstrade option chain and we buy the at the money call, 80 cents. And again, really the stock was at what? 79.41 or something. $80 stock, close enough. You can buy those at 710 and we can sell well, let's see. In this example, the investor bought the stock at 100. So we're going to look at selling the 90 strike calls, which we could sell at 325. We got to sell 2 of them. Now, if we paid 710 and sold at 325, we're paying out 710, collecting a total of 650. That would be 60 cents that we would pay for the 1x2. So very small extra risk, but does that really matter in the long run? And plus we can kind of middle the market. And if we do, we could probably buy these at 705 and sell these at 330. Those are probably pretty reasonable prices to be able to do this with. And if you can't, you have to pay 60 cents. That's fine too. We're talking about 15 cents on a trade where we're looking to get 20 bucks back. So it's the same thing here, right? If the stock is below 80, we still have extra risk. If it's above 80 to 90, we double up to catch up. And if it's above 100, then we give up upside. Here, because we're doubling up, it only needs to get up to 90, up 10 bucks to make back 1965. Now, wait a minute, I'm saying 1960. Oh, wait, 65? Hold on a second. I need to fix that. There we go. Making 1955. So why 1955? Isn't it 20 bucks, right? Stock's at 80, goes up to 90. $10 on the original stock, $10 on the 80 strike calls, exercising those. Isn't it like $20? Yeah, but we're paying 45 cents in this example for the spread. It's not a perfect textbook zero cost 1x2. And if you want to be like ultra super technical, at the exact moment we put on the trade, the stock was at 79. What did I say it was at? Hold on a second. The stock was at 79.41. So actually we would make an extra 59 cents on there. So to be fair, we'd actually make 1955 plus the extra 59 cents because the stock was technically actually a little lower than this. But whatever, that's what I'm saying. Pennies don't matter. We're not going to be penny wise and pound foolish. We're trying to make dollars and not worry as much about pennies. Pennies matter, but what we really care about is this, though. Down below 80, below where it is now, well, we're still long the shares, but in this hypothetical example, I'm thinking support is going to hold, and I do think support is going to hold. So I'm not worried about that downside risk. It's still a stock that I would like to hold. In theory, if it goes down, I think it just becomes a more attractive stock. Again, with options, we don't like to catch falling knife and double up or average price. But with long-term investments, if it's down this much and I like it here, I'd love buying more at 70. So I'm not worried about that. But if hold on a second here. But if OCTA is at or above 80, well, if it's above 80, we're going to still own the 100 shares that we bought originally at 100. But we're going to exercise our 80 calls and buy more at 80, only if it's to our advantage, only if the stock is above 80. And then if it's above 90, it's basically 2 covered calls, right? We get assigned, we sell the stock at 90, the original 100 shares, and the 100 shares we bought at 80. We sell those at 90 and poof, we're out. If the stock is anywhere between 90 and 100, in hindsight, we did something incredibly amazing. Super smart, right? I say smart because we know if a trade is smart at the time we do it. The stock working out and being cooperative doesn't make us smarter or less smart. This is a very strategic trade if we think support is going to hold and we don't think it's going to get above 100 between now and expiration. Very strategic trade. If it does get above 100, we left money on the table. That's okay. Our maximum gain is still only, our maximum gain is still only 1955, which is if the stock is up $10 at 90, that's what we get. So the gist of it is we lost $20 on the initial trade. We should really say initial investment. Spent an extra 45 cents. That's the only extra additional risk. Below 80, we still own the stock. We only lose an extra 45 cents. Whoop-de-doo. Between 80 and 90, excuse me 1 second here. Between 80 and 90, we're doubling up. We're long 200 shares. Above 90, the original shares and the new shares from the 90 call exercise get called away at expiration. If the stock gets up to 90, hey, baby, we're back to even. All right, so I was very thorough and methodical, but you may still have questions. What questions can I answer to help you understand either of these 2 strategies that I shared with you today? What questions can I answer to help you understand either of these 2 strategies that I shared with you today? While you're thinking about that, I'm going to see if Relino's question from earlier is relevant. Yes, I'm losing money on PDD, Pinduoduo. Average purchase price is 130 bucks, losing 2,500 bucks. Now I don't know how many shares you did there. So in order to think more effectively about this, I would like to know how much you lost per share and how many shares you have. So the good news is I still have a long put at the 105 strike from now until January. Now I plan to sell weekly covered calls. So that's a different strategy, and there is a time and a place for that as well. The tricky part with that is timing your sale of the puts, because you probably are not going to want to keep those puts until expiration and just, put the stock to somebody at 105 and end up losing 25 bucks a share on this. The way most traders do it is at some point you're going to have a big profit, a big enough profit on the 105 puts that it offsets some of your loss. It won't be all of it, obviously, but it'll offset some of your loss on the stock. And so you take a profit on those puts. Now, if you're selling the covered calls against it, right now the stock's at 94. You're selling the 95 strike calls, and you can collect around 150 bucks a week. If we're talking about per share, because we got to talk per share, otherwise these numbers are not apples to apples, and I can't help you if I don't know what it is per share. But I mean, if we're talking about, I guess we're talking about 100 shares here, aren't we? So if we're talking about 100 shares, that's $1.50 per week, which is great. That helps also take profits if the stock goes down. You're financing the cost of that put is a way to think about it, because you buy the long-term put and you're selling short-term calls, which is good. And under the right circumstances, this is definitely a viable strategy. And I've done that myself before. The tricky part of this is the stock's at 94. That's a pretty volatile stock. If you're selling the 95 strike, I mean, that's going up less than 1% over a week. I mean, that kind of stock can go up 1% in a day or down 1% in a day. So in a lot of ways, you're risking compromising your whole plan, because you can lose more on that call component than you can win on the call component. Now, don't get me wrong, I love covered calls, and if the stock goes up, yes, you're losing on the call, but you're making on the stock. But the delta of the covered call position is less than 100, a lot less than 100 in this case. It's almost close to, I mean, it's probably like 60, I would guess. So it's a little tricky, and you've got to be really, really good at covered calls in order to trade this. You really need to deeply understand them. So your question then is, how about if the stock suddenly rebounds to 98 or 100? Do I need to roll or let it expire? Yeah. So as far as covered call, I'm going to do a class on covered calls in just a couple of weeks, but the idea is this: yes, you need to roll, and you need to realize that if you do this every week, there are going to be weeks where the stock jumps up to 98 or 100. That's definitely, well, it's not definitely going to happen, but it's very likely to happen. With any covered calls, you assume that, yeah, you're going to skate on it. You're going to keep the premium. You're going to do it again next week. You're going to skate on it, keep the premium. You're going to have more weeks where that game works out, but there is almost always weeks where it doesn't work out and it goes through your strike, in which case you have to roll, but you just realize that it's a cycling through sort of process. Okay, I sold the 95 calls at $1.50. I skate, I keep the $1.50. Great. Sell the 95 calls at, maybe now the stock's at 94 or 93. Okay, sell the 94 calls at $1.50, skate, keep the $1.50. Okay, now the stock's back around 94. Sell the 95 calls at $1.50. Oh, now it's at 98. Okay, well, I've got to buy these calls back at $4, maybe. Or probably more, 4.50. So that wipes out the $1.50 that I collected twice, but I still collected $1.50 on this. I'm buying them back at 4.50. Oh, actually, that's break even, isn't it? Collected 450 or 150, collected 150, collected 150, have to buy it back at 4.50. 150 times 3 is 4.50. But now, with the stock at 98, now maybe I'm going to sell the 100 strike at $1.50. And obviously, it's not going to be $1.50 at the same time, every time. Could be $1.25 sometimes, could be $1.67 sometimes, could be 98 cents sometimes. But, just to make the example easy to understand. So now if I roll up, I'm taking in another premium at a higher strike, which makes it more likely to make money. And I just do that. Basically, I'm actually planning a book on this. Basically, the whole idea is if you should assume that in any cycle of 5 trades or 10 trades, you're just going to get a percentage of the premium that you collect because you're going to have some 100% winners and then some losers. Hopefully that makes sense. That is a great question, and it requires a really, really long answer. And I gave you a medium version of that long answer. Oh, yeah. I figured it was 100 shares after doing the math. Manish says, finally own 100 shares, so how can we sell 2 call options without using a naked call? Because it's not naked. You sell 1 call option against the 100 shares, and you sell the other call option against the long call. It's a covered call and a debit spread. Makes sense? That's why this strategy is so kind of cool. It's really clever. All right. Hey, thanks for spending your time with me. I'm glad that I could spend it with you. And I hope that it was valuable because I'm going to tell you what, under the right circumstances, this can really save your butt. So hope that helps. This is Dan Passarelli, Trade Smart, and I will see you next week. Please mark your calendar. I'll see you next week. Bye.